Imagine a scene. Tomorrow morning, you go to the bank. The number in your account is the same, that familiar figure still there, so you know exactly how much money you have. Then you try to withdraw cash. Transaction declined. You try the ATM. The screen says, transaction cannot be completed at this time. You walk into the branch to complain. The manager shrugs. They can't help you. And on a screen behind the wall, a headline keeps looping. Temporary measures to protect the financial system. Your money, yes, it still appears in the bank. But cash in your hand? Not anymore. Feels like a dream, doesn't it? Here's the problem. This scene has happened before, many times, and every time in countries where people said, that could never happen here. And every time, the biggest losers were the same. Ordinary people who trusted the system the most. In this video, we're going into the real history of how governments and banks trap savings and how the rules change when the treasury is under pressure. From Argentina's Corralito to deposit haircuts in Cyprus, to ATM limits in Greece and India, to the silent, grinding controls in Lebanon. None of this is theory. None of it is a movie plot. Real laws, real crises, real people waiting in front of locked ATMs. And this video will show you something specific, a pattern that repeats itself, a four-step playbook that appears when governments and banks are cornered. And the next version of that playbook may be closer than you think. You're going to be shocked by how predictable this really is. First stop, Buenos Aires, December 2001. Argentina is in recession. Debt has exploded. And people do the logical thing. They rush to withdraw dollars. They try to move their money out. The government panics, because if everyone withdraws at once, banks collapse. And the first level of the game begins. Late at night, a decision is announced. With an innocent name, El Corralito, the Little Corral. Bank accounts are effectively frozen. Cash withdrawals are restricted, limited to 250 pesos per week. Dollar deposits become accessible only if they are converted into pesos at a rate chosen by the state. Think about that. Your life savings, your business funds, your emergency reserve. It's all still there on the screen. You can see the numbers, they're real. But you can't touch them. What's the official explanation? To stop speculation. To protect the banking system. What's really happening? The state and the banks are buying time. And this is only the beginning. This is level 1. If the system is truly in danger, exit doors close for you. Because protecting the system matters more than anything else. Now jump to 2013. This time it's not a fragile country. We're in Cyprus, inside the European Union, a euro-using island state under the umbrella of the European Central Bank. Two major banks are effectively insolvent. In the past, the solution was obvious, a taxpayer-funded bailout. But after 2008, giving public money to banks became politically toxic. So a new word entered the world, bail-in. The state doesn't rescue the bank. The bank rescues itself by taking money from its own creditors. And that includes large depositors. The plan is simple. Deposits under 100,000 euros are protected. Above that, cuts can reach 40 to 50%, and the amount that's cut is converted into bank shares. You wake up one morning and discover that nearly half your savings has been forced into equity. On paper, they call it burden sharing. In plain language, legalized theft. And again, the same familiar lines. We're protecting taxpayers. We're stabilizing the system. Only the rich will be affected. What's really happening? Years of bad loans are transferred onto the backs of people who were told to save responsibly in banks. And the belief that bank deposits are always safe shatters. This is level 2. The bill is handed to you. You're told to pay the price. And Cyprus was not an isolated case. European banking rules now explicitly accept that uninsured deposits can be bailed in under certain conditions in future failures. The way the game is played has become official policy. Greece, India, the power of ATM limits. Now, we move to a softer version of the same game. It starts with limits and continues with uncertainty. Greece, 2015. Democracy at the ballot box and a €60 ATM loop. Greece is at the final stage of a bailout program. Negotiations stall, and the European Central Bank begins tightening emergency liquidity. The result? Banks close for nearly 20 days. ATM withdrawals are capped at €60 per day. What happens next? People stand in lines for hours just to withdraw enough cash for basic daily life. The number in their accounts doesn't change, but the meaning of that number does. Official explanation? Temporary capital controls for financial stability. Those temporary controls took more than 4 years to fully disappear. Now India, 2016, a midnight announcement. The two highest denomination banknotes are suddenly removed from circulation. The goal? Fighting black money, cleaning the shadow economy. But for ordinary people, the result is immediate. Daily ATM limits are cut. Bank withdrawals are restricted. Rules change repeatedly for months. And again, the same story. It's a sacrifice for the country. We're fixing the system. But the outcome is always the same. It's not enough that money is yours legally. Someone else decides when and how you can access it. When does a bank turn into a prison? Lebanon. Now, let's look at what may be one of the harshest modern examples. Lebanon. Late 2019. Years of inflated debt. A currency peg everyone knows is fake. A banking system built to collapse. But notice this. No law appears saying, tomorrow you don't have money. Instead, a silent strangling begins. Dollar accounts are effectively frozen. Withdrawal limits drop to a few $100s per month. International transfers become nearly impossible. On paper, people are still millionaires. But as money melts through local exchange rates, that millionaire status becomes a cheap illusion. Desperation rises, public order breaks down, and people walk into banks, not to steal someone else's money, but to reach their own. This is what slow-motion financial repression looks like. No big announcement, no headline saying, we will seize your assets. Just restrictions, delays, limits, and eventually, a collapse in purchasing power. For your own good. How democracies rewrite the contract. You might think, this can't happen in developed countries, but nothing works the way people imagine. So rewind. The United States, the 1930s, the Great Depression, bank runs explode. In March 1933, Roosevelt declares a nationwide bank holiday, which is just another way to say banks close. A month later, a new order arrives, Executive Order 6102. Hoarding gold coins, bullion, and certificates is banned. Citizens must hand over most of their gold to the central system at an official price. Refusal comes with fines and prison threats. In 1934, the Gold Reserve Act follows. The state takes ownership of the gold, and the official gold price is raised with a single decision. Historians still debate motives, but the undeniable fact is this: the state changed the rules unilaterally. Democracy is not a guarantee that these moves never happen in emergencies. It often just means the packaging is softer and the language is prettier. The 4 steps of trapping savings. Argentina, Cyprus, Greece, India, Lebanon, 1930s America. Put them side by side, and a rhythm appears. Not identical events, but the same pattern. The game is the same. Step 1. Denial and moral storytelling. You hear, our fundamentals are strong. There is no capital flight. Don't believe rumors. Only greedy speculators will be hurt. The goal is simple. Frame the coming measures as moral. Fighting corruption, cleaning black money, protecting national security. The message: good citizens won't be targeted. Relax. Step 2. Soft walls. Limits appear. Daily or weekly withdrawal caps. Extra approvals for international transfers. Hidden restrictions in currency conversion. New reporting requirements for cash. You can still see your money, but now there's a guard at the door. Step 3. Hard walls. Mandatory conversions, haircuts, forced participation. Large deposits face cuts or conversion into equity. Foreign currency accounts are forced into local money. Gold and foreign assets face forced sale programs. At this stage, the message is, you want to exit? There is no exit. Step 4. Slow bleeding. Headlines fade, but the bleeding continues. The currency drops, then drops again. Prices rise faster than wages. Your bank balance stays the same, but purchasing power evaporates. This is silent transfer. Your money is next. What does that mean for you? Let me be clear. I'm not saying your country will become Lebanon tomorrow. I'm not saying a 1933-style gold ban will return exactly as it was. What I am saying is this. Most major financial crises eventually target savings, because savings are the largest and easiest pool of funding inside the system. And the contract you think you sign with your bank is not as sacred as you believe. In many legal systems, a deposit is a loan to the bank. In extreme conditions, the terms of that loan can change. And the tools to lock savings grow stronger every year. Digital reporting, global data sharing, real-time tracking of cross-border movement, and in the future, central bank digital currencies. Principles. Principle 1. Don't treat the number as a guarantee. A balance on a screen does not mean access at will. No deposit insurance limits. Unknown limits destroy people. If you keep your savings far above those limits in a single bank, do it with awareness. Stay alert. Principle 2. Don't put all risk in one basket. Argentina, Cyprus, Lebanon, Greece. The people hit hardest shared one thing. Everything was tied to one place, one currency, one banking system, often one or two institutions. Diversification doesn't have to be extreme. It simply means don't trap all savings inside one country and one banking system. Don't rely only on cash. Consider productive assets and inflation-resistant stores of value. And yes, invest in skills and work that can produce value even when money stands still. Principle 3. Watch the language before the law. Before the law changes, language changes first. Learn the language of power, because it often signals what's coming. When you hear these phrases more often, your antenna should go up. Extraordinary but temporary measures. Fighting hoarding, burden sharing, protecting the system, modernizing capital movements. These are often rehearsal lines before doors begin to close. The real target is not just money. At the deepest level, these are not stories about pesos, euros, dollars, or lira. They are stories about your need to feel safe. As long as you equate a bank balance with security, you will accept higher taxes, higher inflation, harder controls without resistance. As long as the system can say, don't worry, the number is still there, the entire history can be summarized like this. Blind faith in the number on the screen became the strongest control mechanism. So the right question is not, will they take my money? A better question is, am I building my life on top of a system where the rules can change overnight? If this video shifted your view even slightly, you're in the right place. Because every crisis ends with a transfer. Usually from the people who say, it can't happen here, to the small group that prepared early. In the next videos, from gold bans to bail-ins, from digital controls to capital restrictions, we'll track how this playbook evolves. Subscribe if you want to follow it. History is written. The plan is visible. Only one question remains. When the next trap is set, will your money be inside or outside?